Hello, everybody. My name's Bernadette Howlett. We're here today, Andy and I, to talk about what we see as some of the perspectives and how COVID has impacted the general insurance sector, not only in our part of the region, but also across the world. So I have a couple of questions for you, Andy, and it's great to be with you today. Let's start by asking, what do you really think has been the financial impact on P&C insurance from COVID and the pandemic?
Yeah, it's a good question. So, as I'm sure you're all aware, many insurers and reinsurers have announced some quite large losses from COVID-19. A number of insurers have gone out and raised capital. And I'd look at those in kind of two groups. There are those that needed to, and then there are those who were shoring up their balance sheet to make sure that they were able to withstand whatever was going to come and make sure that they're able to take advantage of any opportunities that then emerge. We've seen some rating downgrades. Some quite large insurers and reinsurers have seen their ratings downgraded. And I think times like this really remind you of the importance of dealing with well-capitalized insurers and reinsurers. We often just take for granted that insurers are there to pay claims. But when times are tough, you really want your kind of protection to be with a strong, reputable insurer. So that's been kind of a key focus for quite a lot of clients. Aside from the financials, there's the kind of operational considerations as well, the business continuity, even simple things like being able to work from home simply, everyone having access to a laptop. And many companies found this a struggle at first. Some transitioned quite easily into the work from home mode, and many countries have done this in different ways. Where I am in Singapore, there's been pretty much all companies have been on a split shift since about April. In fact, slightly earlier than that, many were fully work from home for a period of time, and many are now returning more to that split shift. By now, most companies are operating pretty smoothly, but it did take a bit of time to get there for some. There's also the broader kind of economic impact. So certainly back in March, we saw global investment markets dropping quite significantly, and there was quite a bit of cause for concern there on the balance sheet side. Many insurers will have seen their income reduce, particularly if they write things like travel insurance. Obviously, cargo volumes have been down as well, so some shipping and marine insurance volumes have been down. And as an insurer, we care about our clients genuinely. I mean, we want to protect our clients, and we hate to see them struggling as well. And many clients have, and some will continue to struggle and may not be there in the future. So that's kind of the downside. There's tailwinds that have helped us. So, I mean, just looking at the Singapore market stats, certainly motor insurance, health insurance, and workers' comp, employees' liability cover, have actually been doing pretty well, given that there's been less people out and about driving their cars, visiting doctors unnecessarily, and in offices for the workers' comp. So there has been some good news, but we do need to be aware that there will be, these will bounce back. These are kind of one-off temporary effects. So we do need to be very clear on that. There's also kind of secondary claims impacts when economic times are difficult. We typically, as an industry, see an increase in claims in areas like workers' comp and liability, where claims that ordinarily may not have been claimed, some genuine, some maybe not, we tend to see an increase in claims over time. So that's something as an industry, again, we'll need to be kind of aware of over the next year or two.
And you mentioned in terms of the access to capital and insurers being well capitalized through this period. What do you think has been the impact on the reinsurance market generally and the demand for reinsurance during this period? And more importantly, what the next 12, 24 months, what do you think that's going to be like?
Yeah, I mean, so with reinsurers, I mean, there's a natural cycle to the markets anyway. We are in a phase of that market cycle where capacity was tightening and rates were tending to increase. Now, that's not purely over the course of this year been due to COVID, but that will potentially exacerbate what was already happening. Where reinsurers have their capital has been reduced, they've taken some reasonable losses, capacity will be reduced. And I'm sure many companies are seeing that kind of in the 1 January renewals. I think where that will play through to the primary market is particularly for the smaller companies who are more reliant on reinsurance. And in certain markets, quite a lot of the smaller and local players are quite heavily reliant on quota share reinsurance. That will potentially filter through, particularly where either pricing has increased, which will then have to flow on to the primary pricing, or where coverage has been tightened on things such as infectious disease and communicable disease coverage. And again, the underlying insurer will have to reflect that in their wordings if that's what the reinsurers are imposing on them.
So you talk about pricing, and then the answer to the initial question talked about consumer behaviour and things we've done or we've seen in terms of changes around consumer behaviour. Like, I certainly know that in this part of the world, we've seen quite an array of different changes to offers to customers to reward them and to acknowledge the change in circumstance and how either working from home or driving less and the impact that has and should have on pricing and premiums. In your mind, what are some of the other changes to consumer behaviour or their expectations that you think are going to actually influence the way we operate in the sector going forward?
Yes, I think, well, if you look at what insurers will be doing differently, insurers have long been focusing on investing in technology. So that would be both for internal use and for external use, and particularly for kind of brokers and agents. Most insurers will have portals whereby they can log on, particularly for simpler business, to get very quick quotes and be able to bind business very quickly. What we are seeing, and it's not just insurance, this is every industry now, I think one of the silver linings of this situation will be it will accelerate development that was already happening in terms of technology. You and I were talking before this session about how our ability to run sessions now virtually on platforms such as these is probably a light year ahead of where it was last year.
Exactly.
Online distribution is going to become much more of a thing in the future, and the customer, we are certainly expecting to see far more demand from customers to transact online, and we're having to improve our systems and our capability and our offerings in that space to facilitate what we anticipate the customer demand will be. I do also think, depending on how things play out over the next 6 to 12 months, how investment markets play out, if we do start to see insolvencies in the broader industry and within the insurance industry too, I do expect there'll be more of a focus on insurer strength and what I would call kind of a flight to quality, whereby insurers' financial strength becomes far more of a consideration than maybe it was in the past.
Yeah, I'd certainly agree with many of those points. Like we definitely see that from a consumer behaviour perspective, anything that has related to how people have engaged online has just been amplified, and that is now working its way through higher expectations in terms of customer service, higher expectations of the way in which the system is meeting their needs in terms of the performance of their online platforms, the way in which they submit claims online, and the ability to do that all themselves. That's just going to amplify through the system, and amplify in terms of the investments in digital infrastructure, platform environments, and we can already see that happening in the market now in the back half of this year in anticipation of the next couple of years. In terms of just on that, you talked a little bit about channel and more distribution online. In some classes, that's very much driven by particular segments. Sometimes that's driven by the nature of the product. Where do you think that distribution change is really going to hit the most?
Good question. I think the personal lines in particular, I think individuals, for your complex risks where risk management is a really crucial consideration, and it's really crucial to understand the risks that you're facing as an organization for your kind of big commercial business, that will still require that level of personal touch. Now, it might be that the conversations happen via Zoom instead of happening via face-to-face meetings, but I think largely a lot of that will continue the development it was on. The simpler end of the market, your personal consumer lines and potentially business for small, medium enterprises within the business world, they're what I would certainly expect to see becoming more online kind of delivery. And I think there's going to be a bit of a change of awareness coming out of this as well on the part of the customer, particularly commercial customers, in terms of the risks that they face. So things like cyber insurance are going to be increasingly important, given that we are even more so now running our businesses really online. Directors and officers insurance will, I think, increase in its importance, as particularly coming into a harder time potentially in the economic cycle, where companies will be quite focused. And business interruption is an obvious one. And obviously, where you are in Australia, there's been a lot of noise about business interruption claims for small business. I know there was a legal challenge within New South Wales as well. So that's something I think people will become far more aware of and focus much more on the risks that their business faces, the scenarios that may play out, and trying to more clearly understand the coverage that they're actually buying.
Yes, like the business continuity point that you mentioned, that's going to be very, that's very relevant for us. It's going to be interesting to see how that plays out, because not only will it heighten the interest in commercial insurance for particularly small to mid-sized enterprises, but it will make it a little bit challenging in terms of how do you navigate trust and the regain trust in the sector, and at the same time, doing what is the right thing to do in terms of the policy environments and what the nature of the policy is that's written for each of those clients, and the press can opine in one way when the reality of the policy and what that policy covers and is entitled to cover may determine a different thing. So in terms of just underwriting and coverage more broadly, do you think that the pandemic is going to change generally what we can expect in terms of underwriting and in terms of the coverages that we offer in the industry?
Yeah, so I mean, as I mentioned with the kind of pricing in the reinsurance space, there are cycles in the insurance industry too. We were in a natural cycle anyway, where reinsurers and insurers were tightening their coverages and being more sustainable on their pricing. There's a couple of major broker surveys that are published regularly by two of the major global brokers, and they both came out a couple of weeks ago with their Q3 analysis. They both quite clearly stated that most insurers are applying more scrutiny now on their underwriting across most lines of business. They're asking more questions, and they are carefully managing their exposures to the more troublesome areas as well. So there is certainly an overall market backdrop that's happening. And again, that's partly happening anyway and partly exacerbated by the COVID-19 challenge. One thing I would say, and to the point you made before, it really is in the best interest of insurers and clients that there's contract certainty and clarity on what is covered. Because what you don't want is a situation where after the fact there are different interpretations of what is or is not covered, even if it's an area that wasn't really anticipated by either party really before the contract came into existence. Certainly, I think there are insurers in some markets, and Australia is one, the UK is another, where there have been legal challenges on the wordings, which insurers believed were fairly clear. However, they've then been subject to challenge after the fact, which is actually not really in the interest of any parties to get into that level of confusion. So it really does highlight the importance of having super clear, well understood wordings, and that's going to be a focus. And most insurers globally are making sure and double checking that they are really, really clear. Asia has actually fared well in this regard. Look, partly the silver lining of many years ago we had SARS, particularly in Hong Kong. That was kind of an early warning for the industry here. So the wordings were far clearer and far better written. So there's been far less of an issue in this part of the world, but certainly other parts have had challenges. To your question on kind of coverage going forward and trying to get that contract certainty, the whole area of business interruption and coverage for infectious diseases will absolutely be more clearly defined going forward globally. But another couple of examples you can think of, I mean, in the UK at the moment in Lloyd's of London, there's been a big push on cyber, and particularly in traditional policies, your liability and property covers. They're getting rid of the concept of silent cyber. They're making every policy explicitly state whether or not it includes coverage for cyber losses.
Right.
That, again, getting ahead of the curve before anything happens. So it's great. It's actually really smart that they're doing this and doing it before it becomes an issue. The other one you'd be familiar with closer to home was probably just under 10 years ago. There was some quite severe flooding in Eastern Australia, and many home policies did not include flood from certain causes, such as rivers bursting their banks. So afterwards, there was a lot of press and political pressure to ensure clarity. Many insurers opted to make sure the coverage was provided, and they moved, instead of it being on page 3 of the wording, it was put bold and up front just to make sure people were really clear on exactly whether it was or was not covered there as well. So again, I mean, there's always areas that may be open to interpretation, but the job of an insurer is to increasingly try and give as much certainty as possible to the customer.
Yeah, and we certainly believe that this sort of will give it's another sort of threshold in refreshing the wording in policies, the ensuring that they are in a language that is understandable for their clients, and that they're contemporary in either the language used or the expression of what is covered, so that people are on a clear footing for understanding what their policy actually and the obligations in that policy, and the role of product and the product teams in doing that will be very important in the coming couple of years. So just one or two other things. If we could talk about all the information that we now have as a consequence of this year and the role that analytics is going to play going forward. What are your thoughts on the next turn in analytics following the pandemic?
It's a very good question. Again, I mean, this is an area that's been developing significantly over recent years. It's not completely new. So, I mean, you know, we talk about data science, etc., like it's a new thing, and it's not. We've been, you know, insurers have been doing it for many, many years, and you know, actuaries were arguably the first data scientists, really, kind of, you know, particularly on the claims and premium side of things. So, I think the natural progression we were seeing will continue. Probably the one thing I think this situation, this pandemic will cause is, if you think about natural perils, so your earthquakes, your cyclones, your riverine flood, etc., the modeling of that has moved on significantly over the last 30 years. The trigger really was Hurricane Andrew back in, I think it was 92. And following that, you know, a lot of catastrophe modeling companies sprang up. Insurers got far, far better at making sure they knew exactly where every property was, and they had a proper view of the potential accumulations in the event of certain scenarios kind of playing out. If we think about non-property, so things like liability cover, cyber cover, workers' comp cover, etc., there's not the same level of science in understanding the potential accumulations there, and partly because they're more complex and not as easy to visualize. There are probably, or there are insurers out there who are now looking at, you know, the accumulation of loss they've had from this pandemic, and it's not been what they expected. So I do think one area in particular that will develop over the next few years will be that non-property or non-natural perils accumulations, and the understanding of the potential kind of accumulations of loss that might come from those, and being able to manage portfolios better around that.
Okay. If I could take you back to a comment that you mentioned almost up front about strong capitalized insurers and having and there being a pull towards insurers with strong reputation, strong capital bases. Do you foresee greater consolidation, either at a manufacturing level or at the channel level amongst brokers, as a consequence of the pandemic? And we're sort of seeing in some geographies like Canada, for example, acquisition activity in the sector. Sorry, I keep losing my light here in Sydney. Do you have any thoughts on that?
Yeah, I mean, we were already seeing quite a lot of consolidation in the major global broker space. We saw one a couple of years ago, and there's one kind of currently going through at the moment. So I don't think COVID itself will necessarily make any change to that, but there was already a lot of activity kind of happening there. In terms of insurers, I know I saw overnight in the news there was an announcement in Australia that one of the major banks has just sold their insurance arm as well. Within London, there's been a focus from Lloyd's, particularly on the underperforming bottom decile of the syndicates there, and making sure that they up their game or exit the market. So I think there'll be an element of, again, what was already playing through. Where this will happen is, and depending on how the next 6 to 12 months play out, if certain insurers become capital impaired or are struggling to meet ongoing solvency requirements, or their shareholders lose confidence in their management, we may well see some level of merger and acquisition relating to that. Again, some of the insurers that raised capital early did so such that the coffers were stocked in case opportunities do present themselves, and that one from yesterday in Australia probably reflects that.
Yeah, exactly. All right, then sort of a last question. Do you think that in terms of the relationship between, or the role of the regulators in each of the markets and their perspectives in how we're interacting with them as manufacturers, do you see any changes afoot or a different way of working in the markets going forward?
Not hugely, no. I mean, I think if we look at the regulatory development over the last 10, 20 years, there's been a lot. Europe brought Solvency II in, which was a huge change for the industry and brought a lot more professional risk management to insurance companies. What would be a trigger potentially for some pretty serious reviews would be if insurers do fail, particularly some of the small, weaker insurers do fail because of the existing situation. That will trigger an element of reflection and change. I think if the remaining scenario plays out fairly benign and there's no major insurer failures, I would see a continuation of what we've already seen, but no major changes on that front.
Excellent. Well, thank you very much. So that, Andy, it was great chatting with you, and thank you everybody for participating in this session.